All right, Alexi, can you make sure that my audio is coming through? Yeah. Okay, great. Welcome everyone. Once again, my name is Neil Bawa, and I want to I want to welcome both the people in the room as well as the people that are listening on the webinar to this interesting presentation. I wanted to do this presentation for a long time, and I was thinking about different names for it, and eventually the word health check kind of made sense, right? Because I think that, as Holly said, the last 3 years, absolutely phenomenal, especially the last 30 months, and the market has been like a rocket, and all kinds of amazing things have happened. And I think the question that we get most often here is, how long will this last? Does it keep going up? If yes, why? If no, why? People want to know why such an unusual market, unusual things are happening in the Bay Area, and they want to know if there's a way to protect themselves against a potential decline. The first thing I want to tell you today is that there isn't a great deal of agreement about what happens in the next 12 months, but there are a lot of contrasting views. So I went out and talked with a bunch of people about this. Some of them you're going to hear from today as recorded interviews, but not all of them. And there's very varying views about what happens to the Bay Area market. You are going to hear from the national press today. So what does Reuters think? What does Associated Press think? What does CNBC think? You're going to see that today. And what is their view of the Bay Area market? So the second thing I want to tell you is, be very careful not to apply the graphs and charts and information that I'm going to give you today to outside the Bay Area. I was very careful not to take national information and commingle it, because I think people that have been in real estate for a long time know this. The Bay Area market does not reflect the United States market. It is a microcosm in itself. It has its own rules. So everything you see today applies to the Bay Area. It, in most cases, does not apply to outside the Bay Area. And there's a couple of exceptions, and I'll point those out when we come to them. The last thing I want to tell you is, at some point today, I'm going to make a call on what happens in the next 12 to 18 months. This is just my viewpoint. And because there's so much variation on what people think is going to happen, I did what I thought was the best thing to do. Today, we're going to do a live polling session. So at the end of this, once I'm done showing you what the press thinks, what the local experts think, what I think, we're then going to ask you what you think. So I hope that all of you participate. I think everybody in the room has a smartphone. I'll show you how to participate. So, well, you can, maybe she can do it twice for you. So essentially that allows you to tell me, kind of give me knowledge on what it is that you're thinking about the Bay Area. So the questions will come up on screen, and hopefully you can use your phone to vote. And the screen will build a real-time chart of what it is that you guys are thinking. That's very important to me, because a lot of you are in real estate, and many of you are actually in Bay Area real estate. I want to see what you are thinking. So let's get started. But first, a little bit about me. Once again, my name is Neil Bawa. I used to work here in this building, in this college, for 17 years as Chief Operations Officer, worked with Letty, and retired from that job after 17 years about 2 months ago. The reason I retired is that in 2009, I became convinced that I needed to be financially free and have financial freedom, so I started buying real estate. I bought 10 single-family homes in Madera, California, about 200 miles away, and then bought a 7-plex there, then bought triplexes, a whole bunch of triplexes in the Chicago area, and at this point I have all of them, though I've started divesting my California investments and flipping them over to Chicago. And then I got into multifamily, and I invested in multifamily syndications for a variety of syndicators, John Mark being one of them. So his syndication in Texas, but also syndications in other places in Texas, in commercial properties, strip mall syndications, and also syndications in Kansas. And so far I've found, as an investor, when I've invested, those have been my best, overall best gains. They don't match up to what I bought in California in 2009. But you can imagine that that was timing, and I got lucky there, right? There's probably a few people who bought in 2009 got lucky. So they don't match up to that. But anything that I could invest today, my multifamily investments are beating that. So when I left Unitech, I actually decided to go into multifamily myself, and I'm partnered with John Mark on the Chicago presentation. If anybody's interested in multifamily in Chicago, you can talk with either John Mark or Holly back there. Thank you. She gave me the look, so I had to mention her name. All right. Let's get started. So here's our goal for today. Firstly, you heard about me, who I am. Now let's take a look at, we'll start with the statistical data. What is the statistical data telling us? And once again, this is data specific to the San Francisco Bay Area. What is the national press saying? Where you're going to hear from a number of different vendors about what they're saying. One thing I did was, the environment, the macroeconomic environment is so fluid and so odd that I chose not to take any quotes from the press that are more than 3 months old. So everything that you hear from the national press, most of it is actually from the last week. There's one that I like that was from earlier in July. So it's extremely current information. Then we're going to talk about my call. I'll tell you what I think. And then we're going to talk with a community real estate pro. Her name is Diana George. She's actually quite well known. She's presented at a number of meetup groups. And Diana is going to present, well, we've already done an interview, so it's an interactive interview that I'm going to play back for you and for the folks that are online. And then we're going to do live polling. So I want to see what it is that you guys think. Hopefully, because you're going to hear both sides of this, you're going to hear pros and cons. There's not a lot of agreement. You make up your own mind at the end about what you think is going to happen in the San Francisco Bay Area market. All right? Looks interesting? Okay, let's get started. So let's skip this slide. What are the charts and graphs saying? So let's start with the first one, and let's start with history. So look at the San Francisco Bay Area. I hear it from people that the San Francisco Bay Area is somehow unusual and we don't have real estate cycles. The answer is, that's nonsense. We have cycles. But luckily, our area, when it comes out of a up cycle, the down cycle tends to be fairly quick. So you look at the 1991 to 1994 time frame, we first went up for 6 years, and we went up 100%. We doubled in value, and then we went down 11%. So there were 3 down years. 1991 to 1994 were down years for the Bay Area. And then we went up another 6 years in that insane time, another 100 years. And then we went down just 10%, which it always surprises me. But remember that in 2002, the Fed dropped interest rates to 0. So they prevented the real estate market from falling by essentially dropping dropping interest rates to 0.
Sorry, just for reference, what is the geographical area of the Bay Area?
So the 9 counties. So the first slide of my presentation had the 9 counties in the Bay Area. So you've got Marin and, essentially 415, 650, 925, right? San Jose, going all the way down to Santa Cruz, right? And going up to Marin County, and then going east all the way to Livermore, but not Stockton, not, those kinds of places, right? So then we went up, right? We went up for about 5 years, 59%, and then we had the biggest drop that we've ever had. So we had a 27% drop, and that one lasted for about 3.5 years. The market actually didn't start rising until sometime in 2012. Since then, we're now up closer to 65%. So here's what I'm going to do. Every single time I show you a slide, at the bottom of the slide, you're going to see 3 buttons. And those 3 buttons are my view of whether this slide is bullish or bearish for 3 areas that I know almost everyone in the room cares about. Multifamily, fix and flip, and lenders, right? So here's the first one. So before I show you this, any ideas on whether this chart is actually bullish or bearish for multifamily? Or fix or flip? Or lending? Yes? Up? Down? Bullish. It's actually bullish for all 3, and I'll tell you why. There are 2 examples where the market has actually exceeded 65%. So for people that think it's impossible to go up, history doesn't support it. 2 out of the last 3 cycles went all the way to doublings. 100, 100, 59. We're now at somewhere around 65%. So history actually shows that it could keep going. So it's very bullish essentially for all of these 3 areas because these 3 all benefit when the market goes up. Does that make sense? Every chart, we're going to talk about this, and if you don't agree with me, speak up. You don't have to wait until the end of the presentation. All right. So 30-year mortgage rates, right? This is a big deal. 30-year fixed rates have been dropping continuously. Now, one interesting thing about those two big ones that were 100% and 100% is that throughout those time frames, mortgage rates were dropping. They were dropping. One's in this area here, 84 to 90, and the other one was 94 to 2000. And rates were on a downward slope. This time we have a problem because now if you look here at the very end on the far right, rates are now, they've flattened out and they're on an upward curve. So you already see a little bit of an upward bump there. But if the Fed raises interest rates by 0.25% or 0.5%, by the way, I don't believe that they're going to raise rates by 1 or 2%. I think that is extremely unlikely. But if they raise them by even 0.5%, we're going to be on an upward trend. So this one, there's a little bit of a challenge there because now our history doesn't match up with what we are doing here from the perspective of interest rates, which are all important, right? So bullish for multifamily, bearish for multifamily? Anyone? Bullish? Yes? Bullish for multifamily. What about lenders? What about flippers? Is this bullish? Interest rate curve upwards? Yes? No? Okay, here's my take on this. Multifamily, rates going up affect multifamily, but rates going up also are bullish for multifamily. Because when rates go up, affordability goes down for single family. So neutral for multifamily. For flippers, definitely down. Because when rates go up, the flipping business does not tend to do well. This is traditionally tends to pause. With lenders, again, both bullish and bearish. If you're lending your own money, you will get an extra point. Good for you, right? So if rates go up a point, you as a lender are going to make an extra point. But if you're borrowing money, it really isn't going to make much of a difference. It's going to be a wash for you. That's why it's flat instead of thumbs up or thumbs down. Now let's take a look at wages. This is super critical. Once again, this chart is not for the nation. It is just for the San Francisco Bay Area. Ignore every other line except the second one, right? San Francisco, Oakland, Fremont. I hear a lot of comments from misguided people. They believe that the Bay Area will have an infinite rise because people here are making a large amount of money. People know this. Salaries in the San Francisco Bay Area in the last 2 years have risen 7.1% total. Total. They haven't gone up 30%. They haven't gone up 20%. 7.1% is the increase over the last 2 years. Home prices are up 38.6%. Does that compute? Is that something that can go on endlessly? No. I don't believe so. I think mathematically you cannot continue to have these kinds of rise. So this particular slide, not necessarily very bullish for a continued rise in prices. So here's my feel. Multifamily, again, this is neutral. So with multifamily, they tend to benefit when people are not able to afford homes, right? Where are they going to go? They go to apartments, right? So not necessarily the most bullish concept for multifamily either, maybe somewhat positive for them. Definite thumbs down for both flippers and lenders. Definite thumbs down because you can see that the market is straining. When you got 7% salary increases and your cost to buy a home went up by 38%, you're really stretched. And that's not good news for folks that are doing private lending, especially those that are supporting the flipping market. All right, my favorite one. This is tied to the last slide. This is critical because all of the people in power in the United States care more about the affordability index than they do about anything else. When you look at the rental market, the health of the rental market, the one thing you care about the most is where's the affordability. So you look starting from the left. And this is, by the way, inversely proportional. Affordability goes down when prices go up, right? Less people can afford homes. So you take a look at this. There was is this low affordability? Yes. Low affordability around 1991 went up, right? And then affordability started to decline as we got towards the dot-coms. Dot-com bubble popped in 2001. Affordability for, let's say, what are we going to pick? San Francisco was down to about 12 or 13%, and then the bubble burst. Affordability went back up, prices went back down, and then we had the 2008 crash where, and it had to happen really in 2008, San Francisco, only 10% of the people that lived there could afford to buy homes. Marin and San Mateo were not much better at that point in time. They were down to about 12 or 13%, right? Boom, bubble pops, affordability goes back up, prices go back down. And you see how high they went, and then very quickly they came down. Affordability has gone down from a maximum of maybe 25, 30%, now to about 15. This graph is very recent. As you can see, this is 2015 data, right? So you can see how recent this is. Now, this isn't necessarily bad news because there is a precedent for them to go down further, right? So you can go down from roughly 15% to maybe 12 or 13%. The next graph is going to make it difficult for you to think that it's going to go down all the way to where it did, to the 2007 levels, but technically this graph shows that there's a little bit of room. The market could keep going up. So here's my field. Click, click, oh, wrong button. Multifamily, this is unquestionably bullish for multifamily. When you've got affordability hitting these kinds of extraordinarily low levels, people in the Bay Area have to go towards multifamily. It has to happen. Again, this one's bad for both flippers and lenders, simply because this means that even if the desire is strong, and unquestionably the desire in the Bay Area is very, very strong for people to buy, even if the desire is strong, their ability to finance loans is declining. And historically, when it starts hitting these levels, that's when bubbles pop, if indeed this happens to be a bubble. All right, so now let's look at home cost trends. This is very different from the last slide, but it kind of supports it. So what this slide is showing you is adjusting for inflation, what were people paying in different years? So if you look at 2007, in San Francisco, the monthly housing cost was $3,800 and change. Do you see that one? Right? And now, adjusting for inflation, you're just around $3,800 again, right? So even though the last graph showed us that from an affordability perspective, we've got a little bit of room, in terms of raw dollar numbers, we're actually paying what we were paying in 2007 already. We're very close. We're within about 1%. Now keep in mind, since the time that this graph has been taken, already prices have gone up 1 more percent. So we're getting, I believe that those two bars are actually equivalent. So this is problematic. This is why when people come to me and say, we are a magic market and we will continue going up, the rules of real estate don't apply to the Bay Area, and they use the word tech almost as if it's heavenly. This is worship, right? So people here believe in the religion of tech, that tech will magically fix everything and that it's different. But tech hasn't made our salaries go up more than 7% in the last 2 years. Okay? Now, a lot of people had salaries go up, but keep in mind, tech is actually a fairly small industry in the Bay Area. It's a very influential industry. It's an industry that makes a lot of headlines. But for every 10 guys, 20 guys that are making burgers or driving vehicles, there's one guy making that extra money in tech. So when you add up the numbers for a market the size of the Bay Area, it's still only a 7% increase in the last 2 years. So once again, bullish for multifamily. People are not going to be able to buy homes, and I know this is the worst case. This is San Francisco. The rest of the Bay Area is a little bit better. So keep that in mind. This is the worst case because it's the city. But if people are getting up to these peak cost levels, then even within the Bay Area, and I'm not particularly bullish on Bay Area multifamily does have some positive trends going for it. Flippers and lenders, you've got to watch out a little bit. We're getting to the point where the mathematics just doesn't make sense. So now, those were what the graphs were saying, and honestly, there's 10 different ways to read the graphs. I could spend the next 20 minutes going back over those graphs and painting a very bullish picture, but this is the national press talking about the San Francisco Bay Area. So let's start with, there we go. So we're going to start with Fortune magazine. And notice the date. It is last week. People in Los Angeles, San Jose, and San Francisco can expect to dedicate more than 40% of their monthly income on rent. That's 10% above historical norms. In most cases, when you try to get a loan from Fannie or Freddie, if you're above 30, they don't give you one. There are cases you can get up to 31% on mark before you start getting in trouble for single families.
You can go to 40 or 45 even.
Even it depends on the lender, and also depends on the borrower themselves. But 30 to 31 is considered to be the benchmark that Fannie and Freddie want to see for loans, and we're at 40. But this is very important. This is not single family owners. This is rental market. This is what people are renting, essentially, not what people are paying for their homes. So believe it or not, this is bearish for Bay Area multifamily. Something very unusual has happened in multifamily in the Bay Area. As single family prices have gone up, multifamily prices have gone up at an insane rate. Usually what happens is when bubbles develop in single family, multifamily prices increase, rents increase, but they don't go up at the same rate. The Bay Area, something odd has happened. They've gone up at the same rate. So now not only do we have problems on the single family side, what this is showing is we've got problems on the multifamily side in the Bay Area. We're already at 40%. How much more do you think people that are renting will pay? Probably will keep paying 40, but they may not be able to pay 45 or 50. They won't be able to buy food and gas, right? This means multifam in the Bay Area doesn't have a lot of headroom. That cannot keep going up. Rents in the Bay Area are going to stagnate. Now I know this because on the single family side, apparently weird things happen. Sometimes the rules of mathematics and physics don't apply to single family, but they always apply to multifam. So we've got a big glass ceiling here for multifam in the Bay Area. All right, Reuters talks about interest rate hikes. Despite what's going on in China, despite what's going on in Greece, still at this point, economists feel that there are going to be 2 interest rate hikes. What most of them feel, luckily, is that they're going to be quarter point, not half point. Though the Fed has a track record often of raising half point, they believe that the Fed's going to raise it twice, quarter and quarter point. Now, what does that really mean? A lot of people hear all this stuff about interest rate going up, but what does a half point increase in interest rates do? Remember my affordability graph where I said I have all that room from 2007? Basically, if rates go up a quarter point, 2% of the people in the Bay Area can't buy homes anymore, median homes anymore. So if they go up half a point, 4% of the people can't buy homes anymore. And we've now hit the lowest or least affordable market ever. So all that the Fed has to do is raise points by 0.5%, and we will be in completely unknown territory. At that point, every time that's happened in the past, we've had a crash. So multifam, again, is not a thumbs up, it's not a thumbs down, because if rates go up, obviously multifam folks that are buying multifamilies have to pay more interest rates, but then on the other side, it tends to slow down single family, so they get an influx of people moving over to the multifamily side. Definitely bad for lenders. Again, bad for flippers, but again, flat for lenders. Because if you're using your own money and rates go up 0.5%, well, you're going to be making 0.5% more. Sometimes you actually make a little bit more than that because the market changes a little bit or tightens up, so you end up making a little bit more as a lender. All right, so now one of my favorite topics, home ownership increasingly on hold for millennials. This is the Associated Press, and this is from yesterday. The typical first-timer now rents for 6 years before buying, up from 2.6 years in the 1970s. First-time buyers are paying a median price of nearly 2.6 times their median income or annual income. This is not a bad number. 2.6 times, no problem. The problem is the next number. In the Silicon Valley, the median home price exceeds 8 times the income. This is another one of those points where I want to stop and tell people, the people that believe in the tech religion need to stare at that number. Tech cannot make annual salaries go up at the speed that is needed for this to keep working in the Bay Area. There's just not enough tech jobs. So positive for multifam, obviously people are paying a lot for home prices. They tend to move towards multifam. Negative for flippers, negative for lenders. So that, again, all of these ratings at the bottom are mine. Now, keep in mind, not everybody agrees. The presenter that I'm doing an audio interview with in 10 minutes does not agree. She agrees on some portions of it. She's concerned, but she doesn't agree on all of my ratings. All right, another one of my favorites, and this is the one that is the most confusing. Everybody that I ask has a different take on this, so much so that CNBC, within the same article, has diagonally opposite takes. There's concern about the huge loss of wealth from the Chinese stock sell-off, will slow down investment opportunity by Chinese buyers of real estate. So this is Rick Sharda, Executive VP at auction.com, which is a Bay Area-based company. It's possible that the stock market crash may actually have the opposite effect and stimulate Chinese high net worth individuals to move money out of the country and into the relative safety of U.S. real estate. Notice the first sentence and the second sentence don't agree with each other, right? One is saying, oh, the money could be gone. The other one is saying, oh, they could come running here with bags of money because they're fleeing their desperate stock market, their insane stock market. So either one of these things could be true. What I would do is, if you were investing in the San Francisco Bay Area market, I would keep an eye on this. This is a big X factor in the Bay Area, right? So depending on who you ask, the Chinese have poured either $22 billion or $32 billion into the California economy in the last year. If that stops, the music will stop. They are holding this market up, and they're not just holding it up because they're putting money in. Honestly, in a market as large as California, 22 or $32 billion are not big numbers. They're small numbers. The problem is they create hype when they come in with full cash and bid $100,000 or $200,000 or in one case $500,000 over the asking price. They create hype in the marketplace. So if the Chinese stop bringing money into the U.S., all kinds of strange things will happen, right? So watch carefully for that in the next 3 months. You might see the exact opposite, which is money fleeing from their stock market when people figure out over there that their bubble economy is about to burst. You might actually see an influx of money coming in here, in which case the prices are going to skyrocket. But we'll know more in the next 2 or 3 months because unquestionably their bubble has burst, right? Their stock market is now down God knows what, even though they've tried all kinds of illegal methods to keep it up and running, including threatening their own public and private CEOs. Still, the market crashed again 6% today, right? After stabilizing for 3 or 4 days, when they tried all kinds of things, it crashed again today. So, not necessarily bullish or bearish for multifam, because multifam, by the way, is also, this is not well known, the Chinese are not just here, and I don't want to, it's very important that you understand, I don't think that they're doing anything wrong, right? I don't want to say that the Chinese are doing something wrong. They're doing what's right for them. They want to diversify. They have money, in some cases, money that they cannot put in a bank, and they're putting it into a stable market like the United States. For better or for worse, we are one of the most stable markets in the world. They're doing what's good for them, right? So I don't mean that in any derogatory manner. They are also buying multifams, which is why this is not thumbs up. They are buying multifams. They only buy them in the Bay Area for some reason or in New York. The Chinese are not involved in multifam markets outside of Bay Area and New York. Though they do buy homes in Los Angeles. They buy a ton of homes in LA. For flippers and lenders, not necessarily good news or bad news, because I don't know which way this is going to go, but we're going to know in the next 3 months. You know, either the money will stop because there's such a colossal amount of it. Imagine $2,000 million flows every month into the California economy, just coming from one source, Hong Kong. The Chinese money comes in, all of it comes in from Hong Kong, right? We're going to notice. It's going to be obvious. There's going to be lots of items in the press. All right. So now we've talked with the national press. Now let's talk with somebody who's local. So I spoke with a lot of these different people, but the one that was most insightful and in my mind the most fair, even though she's in the Bay Area market and has a vested interest to sell a lot of things here. She is somebody that follows economic trends. She is a fan of John Malden, who writes a lot about macroeconomic trends. So I like the interview. It's about 13 minutes long. Let me play the interview for you. Hang on for a second here. I got to adjust the mic for all my remote folks. There we go. Let's turn this on. And we needed to have a powerful speaker so you guys could hear. Oh, come on. Yeah, got it. Got it.
George. Diana is a broker and the founder of Vault Realty Group based on... We're talking today with Diana George. Diana is a broker and the founder of Vault Realty Group based out of Oakland. Vault is focused on finding properties for investors to flip for a profit, and so they have their pulse on the Bay Area rehab and private lending market. Diana is also interested in how macroeconomics and monetary policy are affecting the real estate market, so we might also hear about that from her today. Thank you for speaking with us today, Diana.
Thanks for having me.
Wonderful. So my first question, Diana, tell us a little bit about yourself and Vault.
So I started Vault in August of 2012. My background was working for an analyst in a private equity firm. I took the idea of making analysts and agents. So we analyze properties on the MLS, and if they make sense, we pitch them to our investors to flip for a profit. Recently, we've grown to about 28 agents, and 9 of the agents on the team are now investors, including myself. And we have grown exponentially, and we're looking to maybe becoming a private equity firm in the future. As of now, we are still looking for properties. We do off-market, we do MLS, so that's how we help out our investors. And we've currently made our clients $3.6 million net in the last 3 years.
Wow, fantastic business model. Very interesting, doing analysis-based investing. Tremendous, Diana. So here's my question. So we're in a great, fix and flip and rehab economy right now. All kinds of wonderful things are happening and have been happening for the last 3 years. But all I hear these days is a huge amount of concern from people that are worried that this market is priced to perfection or is not balanced, and all kinds of bad things could happen. Why do you think there's so much concern?
Because, we just went through one of the biggest market crashes 7 years ago. The other concern is it's the lowest inventory we've seen in 9 years. So this is creating a unusual demand in the marketplace, and it's driving up the prices. We have the Chinese investor, which they invested $32 billion into California's real estate last year. You have more and more private money. More money is becoming available because the interest rates have been at zero since 2008. So there are a lot of concerns surrounding, are we creating another bubble because of all these kind of unnatural items going into the market right now? And so, I also wonder about the economy myself. Like I don't have a crystal ball, but I often wonder, well, how much longer will this last? Maybe another year. Maybe it's going to soften in another year. But right now, what I'm seeing and my agents are saying is fixers are averaging about 22 investors. Fixers are getting about 22 offers, and they're all investors. Then when you flip the house and you're selling it on the retail market, you may be getting 5 to 7 offers. So what that's telling me is that there's more investors flooding the marketplace than there are retail buyers. And that's a little bit lopsided. So, We are in an,
so do
we
you
live
think,
in an
do you think that,
oh, go ahead.
do you think that that's a sustainable trend of having, more investors buying than having, end users buying in the marketplace? Is that a trend that can keep going?
It's a trend that can keep going only because we have seen the lowest inventory in 9 years. And so when someone puts out a product that's brand new, you're having all these buyers jump on it. But eventually now you're having developers coming. Developers jumped into the picture about 2 years ago, a year ago. So, Oakland had just passed this 10,000 unit, well, before Mayor Kwong left office. And so when that hits, you're going to have 10,000 new units flooding the market in Oakland. So what's that going to do to the economy in Oakland? The other complaint is, everyone from San Francisco is flooding in. So that's the reason why, we're seeing these 300,000 over asking offers on some of these homes in Oakland. We kind of live an anomaly in the Bay Area. So the rest of the country is going through something very different. If you go to Chicago or Atlanta, they're where the Bay Area was 3 years ago, maybe even 5 years ago, where their foreclosures have not dried up yet. They still have a massive inventory. So it's hard because we live in a bubble here, and so we see things very differently than the rest of the country does. So it's hard to assess, but over time, I understand the fear, especially when you see what's going on in the world economy. It can't sustain itself. Affordability-wise, it's just not going to be able, for the median household income, it's just not going to sustain itself over a long period of time.
Perfect. That's a good segue for my next question. There are people paying over $4,000 in San Francisco for one-bedroom apartments. How does that work with the whole concept of affordability in the Bay Area? We know that, numbers are very different outside the Bay Area, but within the Bay Area, the affordability index seems out of whack. So how do you see that affecting things in the next 12 to 18 months?
It's hard because the tech sector is a leading industry, but it's still a relatively small industry in San Francisco, but it has accounted for 27% of San Francisco's job growth since 2010. And so what we're seeing is a lot of these younger kids, we're seeing kids graduating college. A lot of them are exceptional. I don't want to take away from that. It does take a certain kind of brain to be into tech. And so, some 25-year-olds are making $120K a year, which is a lot of money for, a lot of people. So when you're 25 years old and you don't have any expenses, you don't know how to manage your money, and you want to live in the city. Now you got Twitter there, you have Salesforce, you have all these massive tech companies in San Francisco, and you're thinking, I'll compete with 10 other people and drive up the rent to $4,000. Why not? I have disposable income. So that's really what drove up the rental market. Now, what we're seeing right now is many people who are starting families or couples or, people who are a little bit more realistic are thinking, I'm not going to pay $4,000 for a one-bedroom, one-bath. That's insane. I can get a $4,000 mortgage equates to nearly $1 million. So you can come over to the Bay Area, to Oakland or Berkeley, and you're getting this gorgeous, 1,500, 1,800 square foot house, depending on what pocket you're in, 3-bedroom, 2-bath with a garage. And so now that's what we're seeing driving out here. How long it's going to last in the city is tough because I think it's really segmented to a certain group of people. A certain group of people are making a lot of money, and so they're what's driving this. And so it's hard to say. If the tech sector gets hit a couple notches, that will affect us. That's definitely going to affect the economy, because our economy right now, I don't want to say is 100% driven by tech, but it is it's a high percentage of what's happening in the Bay Area right now. It's created a domino effect throughout the whole Bay Area. San Francisco is the most expensive city in the country right now. And that's because of this drive that the tech industry has created. I don't know if it's going to go down, but in terms of everyday people, middle class, working class, it's going to get harder. They're not going to be able, right now we're seeing people get priced out. So
So
that's
definitely
why
a bipartisan.
that's why I definitely think there's maybe another year of this. You know, there's probably another year of making this kind of money, and then it's gonna, you know, dissipate or, you know, dwindle, and we're gonna see it soften maybe 10, 15%.
Got it. Okay. So, you know, nobody wants to stop. You know, the music's still on, right? Everyone's still dancing. And people don't want to stop dancing because it's very profitable at this point in time. Maybe a little less profitable than before, but still profitable, right? It's a great market. So if I was a rehabber, you know, what advice would you have for me in the next 10 to 12, 12 months if I didn't want to stop dancing? You know, what should I be looking for so that I can safeguard myself?
What I do for myself, and I'm ultra conservative, is I'm currently on 2 projects right now. And so after this, what I'm doing is it's really hard to find cosmetic fixers. I don't even think they exist anymore. Everything you're finding is a major gut. It's going to be foundation, and you're going to have a lot of issues. So some of the best flippers, experienced flippers I've seen, you know, we're in and out in about 4 to 5 months. Now, is it a good time to take on a development project, something that's going to last you a year or two? Unless you have the capital, go for it, because like I was saying in my presentation last night, is if you have a development, then you can rent out the units. You can lease units, and the developers are fine. Ideally, they want to unload them, but if the market hits a bottom, hey, I'll just lease all these until the market comes back, and that's exactly what happened in 08. Now, if you're a rehabber, you want to be smart about where you're rehabbing. I mean, A, you want to look at the numbers. B, you probably don't want to be in an area that's you're not accustomed to, or you're not feeling safe about. Maybe it's not that great of a neighborhood, and you're thinking, well, hey, I'll make good money. And I don't want to tell you to miss those opportunities, but I'm going to tell you to be smart about it. You want to flip in pockets probably in the next 6 months, and I'm saying you probably have another 6 months of going wherever you want, and then I'm probably going to take a lot of caution. So flip in areas where you know are, okay, maybe I can live in this house. Maybe I can rent this house out to house out to tenants or people looking to live over here. Can I make my mortgage? If I rent this house out, if the market does crash, could I rent this out and make my money back? You always want to think big picture. What's going to happen down the line? What's the worst case scenario? So always, none of us want to talk about worst case, but you have to. As an investor, you have to weigh all the risks because it's a risk and reward situation. So what are your risks? What are your rewards? And that's what I would advise to any investor moving forward is look at the big picture. What if I don't sell this house? I mean, I know investors now who, you know, they've called me after the fact. They didn't work with us, but they've called me after the fact because they were pitched another deal from another agent. And, you know, it's just they're in a neighborhood where no one wants to buy there. And so you just have to be smart about where you're buying.
Makes sense. Well, excellent advice, you know, risk mitigation advice for rehabbers. What about our private lender community? Should they be looking to do anything different? Is it similar advice for them as well, just, you know, on their side of the fence?
It's funny because a lot of good friends of mine are in that realm, or VCs that invest, and a lot of them just think we're going to be in this, you know, spectacular bull market until 2017, if not longer. They call it the quote unquote, we're in an unusual bull market. I love hearing that. I can't even tell you how many of my friends have told me that in those sectors. But then I do have people in the private equity sector or private money sector that are very conservative. And, you know, their whole thing, some of them have not changed their programs. They have the same exact programs they had in 2008. What we're seeing is some private money guys are loosening up. You know, they're taking less down payment. They're taking the less down payment's the scary thing, because if an investor has less skin in the game, they care. I mean, I don't want to say they care less, but they're not as worried. But there's, you know, some of the guys I've worked with for years are not changing their programs. They're keeping it the same. They're keeping these stringent policies that they had, you know, 7 years ago. And the problem is they told me they're losing a lot of business because we're seeing this influx of private money guys from Los Angeles come up to the Bay Area now, you know, coming in with these kind of loosey-goosey programs, and people are jumping on it, which is great for investors, don't get me wrong, but if the market did take a sudden dip, these guys would be out of business. I mean, back in '08 and '09, was it, we were seeing, I remember reading this article back in 2009 that 50 brokerages were closing a day in California, mortgage brokerage, real estate brokerage. That's how bad it was. I'm not saying it's going to be that dramatic, but these guys need to be careful. So if I was private money, I would still keep my guidelines strict. And if I lose some clients over it, well, I'll lose some clients over it, but at least I won't lose sleep.
Makes sense. Makes sense. Well, that's fantastic advice for lenders. I hope our lending community, our private lender community, is listening very carefully and again, not following, these loosening standards that could increase their risk levels. Fantastic. Any other advice for us, Diana? We've got people in the room, again, that are rehabbers, private lenders, some wholesalers as well, and then the usual multifamily folks, because we're a multifamily group. What about multifam? Should we be looking to buy multifamily in the Bay Area right now, or we shouldn't?
Here's the thing. This is what I tell all my clients. A lot of property management groups I speak with, and there's some huge ones I talk to. There's one in Silicon Valley. They have about 70 homes in their portfolio. There's a woman here in Oakland I just spoke to the other day. She has 50 homes in her portfolio. What they've always told me is, and I take that same advice to when I'm flipping, is if the bottom line makes sense, go for it. I mean, yeah, it's not the best time to buy and hold. I agree. The best time to buy and hold is when the market dips. That's the acquisitions period. But if you presented a house off market, or even if you see a house sitting on the market for, I don't know, maybe several weeks because for whatever reason it's not selling, and the numbers, you're looking at the numbers and you're getting a 10% cap rate, you're getting a 12% cap rate, or whatever it is, go for it. Because right now, I mean, in Oakland, 4 years ago, 15% cap rate was normal. Now, Oakland, the average is 8, unless you're going to the east side. And so it's really hard in Oakland to find anything above 10. But if you're a buy and hold and you're like, hey, I just found this multifamily, I can make 10, 12% on it, go for it. If the numbers make sense, do it. I started investing out of state because the cap rates are so attractive. And then you just hire a good property management group. So if you're someone who really wants to build your portfolio and you're serious about buy and holds, definitely look in out of state. South Shore Chicago is a great pocket right now, amazing.
Yes.
Atlanta, Georgia is another amazing pocket. I heard some people saying yesterday you could pick up homes for 60 to 80,000, and then the rents are about 1,000.
Better for single family.
So those are incredible cap rates right there. You can't beat that. As far as the Bay Area goes, again, if you see something that makes sense, do it. Go for it.
Makes sense. So multifamily folks, follow the cap rates. If it makes sense in the Bay Area, do it. But otherwise, as you said, Atlanta, Chicago, and maybe even, some areas in Texas are great ones to follow.
All right. So very interesting. Let me grab the mic back. So here were my top 5 takeaways. What she's saying is, don't do longer term rehab projects unless you can sit on them, right? You don't want to borrow a lot of money at an expensive rate and do a long-term rehab rate. So be very careful if you're doing that. Same thing on the lender side. If you're a lender lending, right now is the time to be a little cautious about the longer projects. They may seem awesome projects with awesome people developing them, but when the market turns, both the good and the bad people get killed. So be careful. She's concerned about affordability. She was saying people are moving out of the city. People are moving out simply because they can't afford the rent. So she's worried about that. She talked about the Chinese folks. Everybody's worried about the impact that the Chinese are having in the Bay Area market. She talked about the tech bubble. So she said if it goes down a notch or two, it really affects the market because our market is really driven up by tech. And then she's worried about looser lending standards. The problem with looser lending standards is other lenders tend to follow. Be careful not to do that Because if you loosen your standards simply because somebody else is doing it, you'll both get killed. Be careful. So her call, which I told her before the interview, I'm expecting you to make a call during this interview. And she didn't do it for a while, but eventually she did. So she said she thinks it's 12 months, then a 10 to 15% decline, right? That's her call. And after we finished, I repeated that to her, and she said, yeah, I'm comfortable with that. So it goes for a year. So now that Diana's made her call, I'm going to make mine. Mine's a little bit different. I see the Bay Area market starting to decline in Q1 of next year. I think that we've got the rest of this year is fine because there's so much going on around the world that it's not going to affect our market. But I think there's going to be a decline. I don't agree with her that it's going to go down to 15%. I think we're going to see a shallow decline. To me, 5 to 10% is more likely. 15% is too much. There's a lot of good things going on in the Bay Area. I don't think the market declines that much because what happens is our market historically, have you seen how short the declines are? There's so much money in the Bay Area that the moment the market hits a 10% downturn, people step in and start buying homes again, right? So it never goes further than 10%. History says it doesn't. Now, it did in 2008. But have you noticed how quickly it snapped back up? The Bay Area market went down fast and then went back up fast. So my call is starts to dip in Q1. So be careful if you're doing lending projects more than 6, 7, 8 months out. You may get trapped in a declining market. And then it declines 5 to 10% and then stops there for a while. So that's my call. So now I want to do something interesting, and I've never done this before, so I hope it actually works. Whip out your smartphones. You've heard the national press. You've heard what Diana had to say. You've heard what the statistics said, and you heard my call. I want to know what you think, right? So if you're ready with your smartphone, open a browser in your smartphone, or if you have an iPhone, open Safari. If you have a Google phone, open Chrome. And this goes for the remote people as well, right? Please go to bamf.participole.com. No www required. bamf.participole.com. This is an anonymous survey, by the way. Don't tap on the screen. Just let me know when you're there. So whoever's on the screen, please raise your hand, right? Once you're on the screen, raise your hand. Only one so far. There we go. More people. All right, come on. bamf.participole.com. All right. Now, for the remote people, I realize that if you're watching on a phone, you've now covered up your screen, so you cannot read the questions. So I'm going to read the questions out to you. Okay? All right. So here's our first question, and it's the most important one. The biggest superhero of all time is Superman, Batman, Iron Man, Spider-Man, or E, I prefer supervillain. So please vote. A, Superman, B, Batman, C, Iron Man, D, Spider-Man, E, supervillains. And note what's happening on the right side of the screen. The bottom right of the screen has a number. As you're voting, it's increasing. Right? Everybody done? Yes? Okay, we're up to 18. Anybody else voting? Going, gone. The biggest superhero of all time is, oops, what did I just do? Click the wrong button. Oops, got to do that again. Sorry, guys. One more time. Click the wrong button there. All right, vote, vote, vote. There we go. That was quick this time. You guys are catching on. All right, and it is... an easy win for Superman. All right. So now let's get to real estate. That was just a teaser, just to get you into the system. All right. A year from today, single-family homes in the San Francisco Bay Area will A, cost more, B, cost less, C, cost about the same, D, I have no idea. All right. 8 people have voted. Keep going. Keep going. We got to get to about 18. That's how many people are voting. 16, 17, 18, 19. Anybody else? Going, gone? Let's see. All right, so 37% think they'll cost more. That's very interesting. So people believe that the market will continue to go up. Surprising, but not necessarily counterintuitive. We've seen a lot of increases, and people have been talking about it going down for about a year and a half now, right? So 26% feel that the market is going to cost less, 32% about the same, and, well, everybody has an idea. Only one person didn't have an idea. All right, next. My gut says I should buy a multifamily property in the Bay Area in the next 12 months. A, yes, it's a good idea. B, no way. C, not sure. A, B, or C?
That's so cool.
Hey, I want to know what you guys are thinking.
There's no idea.
All right, gone. 42%, yes, want to buy in the Bay Area. 47% say no way, do not want to buy multifamily in the Bay Area. And then 2 people are not sure. Next question. As a private hard money lender, here's what I would do in the next 12 months. A, business as usual. B, tighten my lending standards and reduce risk. C, stop lending. D, switch to lending to projects outside the Bay Area. Please vote. Now, if you're not a lender, you're still allowed to vote. That's okay. If you were lending, just think what you would do. But this time it said 0. Yeah, it didn't vote. For some reason, this slide's not connected. All right, let's move on. Sorry about that, guys. I rehab homes in the Bay Area, and here's my plan in the next 12 months. A, business as usual. B, more selective in picking my projects. C, stop doing rehab projects. And D, switch to rehabbing projects outside the Bay Area. So very similar to the lender question, right? We want to see if people want to keep doing what they're doing or they want to do something different. All right, 14, come on, a few more people. 15, 16, 18. And the answers are, aha, this one is interesting. Less people, lenders are more conservative, it seems, than rehabbers. Only 3 people are going to do business as usual, but a lot more are going to be selective in picking projects and reducing risk. I think this is wise. So C, only one person is going to stop doing projects, and then a whole bunch of people are actually going to switch to rehab projects outside the Bay Area. Once again, I want to remind people, what you just saw is not a representation of the United States real estate market. By historical terms, the U.S. market still has tremendous affordability. Tremendous. It's just the Bay Area market that's different. All right. If interest rates go up, right, this is a big one. What impact will they have on the San Francisco Bay Area market? A, this market is on a tear. Prices will go up regardless of interest rates. B, prices will stop rising if interest rates go up. C, significant negative impact, home prices will decline. D, huge negative impact, home prices will crash. Voting? No? Okay, here's what I'm going to do. Hang on. Let me cheat a little bit, because I want to know the answer to this one. All right, insert poll, A to D, insert poll. There we go. And click. Okay, let's try it again. Hang on. Okay, server connection lost. Hang on, go here. Okay, now it should work. Go ahead, vote. Yes, no?
Yeah, there it is.
There you go, okay. Sorry guys, new technology, always buggy.
This is the church we're worshiping at?
That's right. Some days I actually feel like I'm the priest of the Church of Technology myself, as you can see. Okay, 16, come on, a couple people. There we go, 17, one more? No? There we go. Okay, so let's find out the answer. 58%. This is actually the most unanimous one we've had so far. I think people are convinced that prices will stop rising if interest rates go up. I think that's a fair bet, because affordability gets very negatively impacted by interest rates. Very negatively. Now, what's interesting is my friend Jarmark here usually tells an anecdote about buying a six unit in San Francisco, and the rates were at what, 18%?
19.
So there's still life if interest rates go up, but it does impact markets. It changes their path quite a bit. It's, interest rates do not equal real estate crash. It simply means that sometimes the market, the momentum changes quite a bit. That make sense? Okay, was this useful? Right? So you kind of know what people in the room are thinking, you know what people online are thinking. All right, so let's recap. This is the oddest market ever. The Bay Area is a crazy market, and what's important is there's not a lot of agreement here. It really depends on your risk appetite. Are you a lender? Are you somebody that's a rehabber? Are you somebody that's looking to do multifamily? It's going to impact things. The purpose of today's presentation was to really make you start thinking about the fact that we are at the point where you need to be very connected with your community. If you're a lender, really be listening to what your rehabbers are saying. If you're a rehabber, look at the market. The one thing that really alarmed me in what Diana George said is, she said the average property on MLS that's a fix and flip property has 22 offers, right? And most of them are investors, right? That's the definition of a crazy market. Crazy markets don't go up forever. So if you're a rehabber, you may really need to think about whether you want to engage in a market where 22 people are making an offer on a fix and flip property. This isn't, Hugh Hefner's mansion that they're bidding on, right? It's a fix and flip project. So be careful about this market. These are strange times, and we don't know how long the music is going to keep playing. So be careful and keep connected with your community. The community will tell you everything you need to know in case you want to keep playing in the Bay Area. I'm assuming that people that are playing in the Bay Area want to keep playing. If I was them, I'd want to keep playing too. I would just be a little more careful in terms of looking at my risk. Does that make sense? All right. Any questions? Q&A. Yes.
What about the fundamentals of housing supply and population growth? Those things that drive up demand.
Okay, so let me repeat your question for the online folks. What about the fundamentals of housing supply? You've got population growth, you've got supply issues. How do they affect pricing? Interestingly enough, they have an outsized effect on pricing. So one of the things that Diana George said, which really needs to be underlined, is we're seeing the lowest inventory ever in the Bay Area, right? So what was the next thing she said after that? The developers are getting into the game. Inventory is always a time window. So Oakland just by itself just approved 10,000 units. Guess what happens? When those units start flooding into the marketplace, now all of a sudden you see the reverse side of the supply problem. Instead of having a demand issue, you now have a supply issue. So the answer to that is it always corrects itself, and it usually corrects itself within a year or a year and a half. So right now we've got a massive number of multifamily and single-family projects being built in the Bay Area. The market will correct itself, right? So it can't keep going up like that simply because the supply will correct itself. With regards to population growth, I don't think it justifies the massive price increases. We are 65% up in price. We probably gained 4, 5, 6% population growth during the time when we went up 65%. I'm not so sure that population growth is what's driving our market. I think it's more hype. I think it's tech. I think it's Chinese investors buying in cash that are driving up our market, and not necessarily population growth. The entire United States has population growth. Our country went from, when I came to the US, we were under 300 million, we're at 325 million. Obviously, not all of that is the Bay Area. So there's population growth in the country. Why aren't their prices going up 65%? So it's not all population. Does that answer your question?
Yeah.
Okay. Any other questions? Yeah. Joe?
The Chinese just devalue their currency, so wouldn't that make real estate in the U.S. more expensive to them and cause a drop in Chinese investment?
Yes. Keep in mind that, so it is one factor. So the Chinese devalued their currency by 4.5%, right? So if all the homes in the United States were purchased by the Chinese, we would now charge 4.5% more money. But actually, a very small fraction of all homes in the U.S. are purchased by the Chinese. Even in the Bay Area, a very small fraction are purchased by them, maybe 5 or 10%. So you could have an effect that's 1/10 of 4.5%, which could be 0.5%. So it's a factor, but it's a 0.5% factor, not a 5 or 10% factor. Yes? Okay. More questions?
Yeah, how about the local politics and local culture that they want to restrict growth? You know, that drives demand too. I mean, the supply equation, right?
So let me repeat the question again for the online folks. What about the culture, local culture of restricting demand and not allowing more housing, not zoning more housing? Yes, unquestionably, that is one of the factors that's driving growth. Fremont is an especially tyrannical city in that we do not want to grow. We like where we are, and we've got all this space up on the hills, and we basically just say no to everybody that wants to develop it. So yes, that is happening. It's a very significant factor. Having said that, people are very innovative. There's still a ridiculous amount of land in the Bay Area. Right now, we're building a tremendous amount of new supply in the Bay Area. It's just, it hasn't come online yet. Now, if the Bay Area keeps growing at this rate for maybe another 10 or 15 years, we may truly run out of land. But at this point, I don't see that happening just yet because the amount of land development that's going on, new home development in the Bay Area in the last 12 months is huge. It's enormous. Any other questions? Okay, all right, I'm going to hand over to Jean-Marc so that he can give us kind of an update on the multifamily side. We are a multifamily group after all. We didn't talk about multifamily much today, but here's Jean-Marc.
Put myself in here. Okay, so just a quick introduction, Jean-Marc. I actually bought my first multifamily in 1982. It was a sixplex, and as Neil mentioned, it was at 19% interest, and obviously the interest rate does affect values. And when I bought in 82, quit my job as an engineer, rehabbed it, and 9 months later, rates dropped to the incredibly low 12.5% rate. And I refinanced and pulled out 4 years worth of salary as an engineer, and they're worth that career. But what I did, I played with multifamily for 7 years. I bought and sold multifamily for 7 years after that, and then got into a battle with the rent board and decided to stop buying, and that was probably the silliest thing I've done in my life. Until I became a lender until 2008, when that was no longer a viable business. And reading a book by Dave Lindahl on emerging markets, I finally understood, that's what I was missing. Everyone thinks about buying in your backyard, buying where you can drive to. You have to be able to drive there in 20 minutes, drive there in an hour, 2 hours. I had one developer client when I was a lender who would only build within an hour's flight time because it was a pilot of his house. So his investors, after several successful deals, bought him a faster plane. So that one went pretty well. But part of the light bulb in reading Emerging Markets by Dave Lindahl was that you're not stuck in your backyard. Markets across the U.S. go up and go down, obviously, but at different times. So in 2008-9, when everything else was crashing, Midland and Odessa, Texas were going gangbusters. So was North and South Dakota. Now it's sort of the opposite. Everything else is going gangbusters, and those oil regions that took off when everything else was crashing are now crashing when we're taking off. So I look at the Bay Area and I look at the difference, the ratios between rent and prices. And in San Francisco, you can buy a sixplex at, let's say, $500,000 a door, and you get $4,000 a month rent. In Texas, actually, I'll use a Chicago example. In Chicago, we're buying properties at $50,000 a door, so a tenth, but we're getting $900 to $1,000 rent on average. So that would be like, in San Francisco, you're getting $400 versus $900 to $1,000. That's the price difference. In Dallas, we just closed one 3 months ago. We paid $23 a door. We're getting $600 a month rent. So the ratios between rent and income are so much better outside the Bay Area, which is why you're getting 8 caps, 9 caps. The Dallas deal we closed at 9.1 cap. In San Francisco, I've seen things like 1.2 cap. It's like, yeah, I'm gonna go buy that. You know, for an insurance company that has lots of money and their cost of capital is 0.2%, they can sit on that for 20 years and they'll sell it and they'll double or triple or quadruple their money over time. That is not a model that's scalable. We're not sitting on that kind of capital, and I can't grow my capital that slowly. I did lose some money in 2008, and I'm regrowing, and definitely am more impatient than sitting on money at 1%. So the Texas deal we closed, we're at 14% cash on cash, and that's not counting the upside. And that was at 89% occupancy. We're now at 96% occupancy, and cash is even better. So the big takeaway is so many people, even today, really want to buy in the Bay Area, really want to buy where they're living, because they want to drive to it, they want to touch it. And you just, somehow you have to wean yourself from that instinct. I know it's great to do. I loved seeing my properties. I was driving all over San Francisco. I had 57 units at one point. And it was a job. And it was a single market. And when that market crashed, I was stuck. If we have, like in the past 2 years, we've picked up a little over 800 units in Texas mostly, Texas and Oklahoma. San Antonio, Longview, Dallas, and Houston. All of those markets are doing well. If one of them crashes, Longview just had a downturn this week, and I just saw the blurb and I haven't even understood why yet, but 4 or 5 large companies laid people off, and our occupancy dropped 4%, just like that. In Houston, we're in North Houston, just 4 miles south of the new ExxonMobil campus. They're adding 10,000 jobs despite the downturn. 10,000 jobs at one company creates 30 to 40,000 support jobs. So you have this huge push up. We pretty much doubled our equity in a year. We bought for 7.6 in February of 14, and we're now in contract to sell at 10.2. That was supposed to take us 5 years. We did it in one. Where the seller, the buyer is, has hard money down. We're just waiting for the assumption to go through with the lender. So that one we exited much faster because there was such an upsurge, and because we weren't quite sure what was going on with the oil economy. And oil is huge in Houston, but it's only 13% of the economy. You go to Midland and Odessa, I don't know the figures, but it's way higher than that. I did a loan for someone in buying a hotel in North Dakota. They actually bought it at 32 cap because they used pre-surge pricing, and now they're back to just kind of making it work. Before they were just breaking it in, but they had gone from 60% occupancy at 55 a night to 98% occupancy at 130 a night, and now they're back to where they were before, because there's no more drilling, and there are far fewer jobs for just running the place and drilling. So it was kind of funny and a surprise. Diana George mentioned Chicago South Shore as one of her favorite places, because we right now have a property in South Shore. Actually, we have 6 properties in South Shore, Chicago, under contract, 237 units. And it was really, having bought so many units in Texas and seeing the Texas market, if you think of the sine curve, you're halfway up, or we don't know how far up into the rise we are. Are we in the 5th inning, 6th, 7th, 8th? So I was looking to diversify. And there was someone from our group here that had moved to Chicago that kept telling me, come look. A friend of mine, Ethan, through the Lindahl Network, lives in Chicago and kept telling me to come look. Neil's been buying in Chicago, albeit on a different scale. And I received this, one of many solicitations in the mail for, a call for offers. And I opened it up, and this gorgeous high-rise 16-story in Chicago, and I went chasing that and fell in love with the area. And where South Shore is, we're all looking at emerging markets, right? So South Shore is not the greatest part of Chicago. It has a reputation for being a rough area. Just north of it is Hyde Park, which is where the Obamas are from. And University of Chicago is there, and University of Chicago is buying up everything they can, and prices are rising. And there's a 40 to 60% rent differential between Hyde Park and South Shore. So the very northern tip of South Shore, north of 71st Street, there's like a 4 or 5 block area in there, is kind of the best part, the best pocket in all of South Shore, which is actually fairly large. And basically, we found this right next to the tower I was looking at. We found a portfolio of 4, and then another portfolio of 2, with both of those in contract. And passed on a couple of things south of 71st Street, which is more the dividing line. And we're seeing more and more people priced out of South Shore, priced out of Hyde Park and moving south. On the south side, about a mile south of us on 79th Street or 80th Street, there's a huge development, 14,000 homes going in. And that's a 20-year project, maybe even 30. I'm not going to bank on, if this is a 3 to 7 year hold. We're not going to see a whole lot of effect from there, but that's going to have positive effect on, 79th Street is kind of the bottom of the barrel in South Shore. You don't want to buy on 79th Street. You don't want to hang out there at night, at least. If you're a speculator and you have, you're solid, you can go there. But so we have that influence from the south. So it's this really cool little pocket that we found, and clearly Diana likes it as well. And you've been there for a while.
Yeah.
So we actually have a video, which is pretty cool. The webinar can't see the video at the same time.
That's right. For the webinar folks, if I can have the mic back. Folks, if you're on the webinar, please note that you cannot see the video because it's going to be very choppy. Webinar software don't do videos, so please look at the screen. We're going to end the webinar at this point in time. It's a 6-minute video. To watch it, go to YouTube and type in Chicago Lakeside, one word, Chicago Lakeside Properties. It's the first link and looks like the link at that picture at the bottom. So we're going to end the webinar. Thank you all for attending. Let me click this and I'm going to stop and end webinar for all. Yes.